Well, welcome out to BluSky's Technical Trading Lab. This is Coach Matt, your host with the most, and we are going to be talking about the technical playbook. Last year, just to kind of give you an understanding of all the conversations that we had last year. Um, how many attended more than five Coach Matt labs last year? I know quite a bit did. Yeah, RQ, Heavens, yes, Ace, right? We got the core. Didn't miss, love it all. Love it all. Just to give you an understanding of some topics we covered last year, team. Um, Here's all the slides that we covered just in the ones that we did presentations on. And I was reviewing all of this material over the weekend of things we covered throughout last year. You named the topic, we covered it last year. From every patterns to indicators to candlestick analysis to trends, you name it. If it was a technical conversation, we had it last year. I'm only halfway through the slides we went through, team. Like there was a tremendous amount of topics, a tremendous amount of information, and we're going to do the exact same thing this year because the goal of this lab has been and will always be one thing. Every week, we want to increase our financial IQ and have fun doing it. Correct? That's the goal every single week. Increase the financial IQ and have fun doing it every single week. And I look back at our year last year, specifically in the concepts we covered, the conversations we had, the techniques we went through, and I loved it all. Every lab I enjoyed, every conversation I enjoyed. But I thought to myself as I was going through all of those slides and the techniques that we covered, I asked myself, is it time to put this all in a specific operating plan? And so I decided that what I want to talk about today and what I'm going to do over the course of the next 2 to 3 months. If it takes me a quarter, it takes me a quarter. If it takes me 6 weeks, it takes me 6 weeks. It's not going to be 6 weeks. We're going to have much more longer conversations than that. But I want to build the BluSky Trading Technical Playbook in this lab. And what I'm going to do, team, is every single week, we're going to identify a technical pattern and we're going to break that down from A to Z. We're going to break that down from the visualization of the pattern. We're going to break that down from how you trade the pattern. We're going to break that down from entry stop targeting techniques. We're going to break that down from primary qualifications to secondary qualifications. Because when you start visually identifying a pattern in the market, that's one thing. Knowing exactly how to navigate it is another thing. And so I'm willing to bet everybody here knows what a bullish breakout is. For example, yes or no. By the way, Coach Matt Labs, you don't sit on the back seat. You got to answer questions because if you don't, I'm going to spend half of our lab time telling you guys to answer questions. Okay. Everybody understand how that works? You don't come to Coach Matt Labs to sit in the back. All right. So everybody knows what a bullish breakout is. How many specific forms of qualifications do you analyze in determining the quality of a breakout? Because not all breakouts are, oh, if you're cooking, you're good, Ace, brother, you're good. Oh, I want some of what you're cooking. But not all breakouts are equal. Can we all agree with that? Not every breakout in the market is equal. Some are better, some are worse, some you want to take, some you're like, no. What are those specific things that you look for in determining a quality breakout? And we're going to talk about that today. And so No, they're not. Coach Matt breakouts on silver and gold usually have a little bit more to them. There's no doubt about that. So we're going to talk about the breakout. Before we do that, though, I want to have a general conversation of what we're trying to accomplish here. Because there's not just one pattern, there's not just two patterns, there's many patterns out there in the market, and I find it's very important for us to master every pattern in the market. But the beautiful thing about mastering patterns is there's tissue that's connected. There's a lot of similarities between pattern recognition. And once you understand how to identify patterns, yes, history doesn't repeat itself, but it certainly does rhyme. And I would say the exact same thing about patterns. A flag-based pattern versus a standard retracement versus a deeper retracement, they all have a lot of similarities. There's just a couple key differences in navigating those patterns. Looking at an ascending triangle versus a cup and handle, little bit of a different, a little bit of a similar pattern, but there's a couple important differences on those. And so pattern recognition in the market is deeply ingrained in us. And before you even start getting into identifying patterns in the market, you got to understand that patterns are visually based. That patterns have a tendency to repeat themselves, and patterns manifest themselves in all aspects of life. Patterns are based on our DNA. And so the earliest patterns in the market that human history that we would look at was the constellations. And you would look up into the nighttime sky, and there's a billion stars up in the nighttime sky. But all of a sudden, you can identify 7 stars to identify the Big Dipper. You can identify 3 stars to look at Orion's belt. You can identify all these things based on patterns. And so and I want you to think about that for a second, just from the high level visual perspective. Because sometimes when we pull up a chart and we're looking at a chart of the marketplace, sometimes it's difficult to identify the specific pattern in the market. But yet, in a world where we have hundreds and hundreds of data points here, sometimes it's hard for people to determine what the pattern is based on all these different data. In fact, how many of you guys have struggled at times with identifying specific patterns against hundreds of different candlesticks out there? And let's be honest with one another. Yes or no? How many of you struggle with pattern recognition against the backdrop of all the data in the marketplace? Time frame matters tomorrow. I agree with that. But even on longer time frames, it can be a little bit difficult. Okay. So let me ask you guys a question. How many of you can find the Big Dipper within 10 seconds when you look at the nighttime sky? Literally, legitimately, within 10 seconds. You don't know how to see the Big Dipper, Omaro? Oh, oh, I gotta teach you that one, my friend. Who here knows what the Big Dipper is? Let me start with that. Okay, vodka. How long would it take you to identify the Big Dipper in the nighttime sky? How long? You are a smart man, Omaro. You're in this lab. You're a smart man. How long? 1 minute. Okay. How long would it take somebody who's not familiar, say Omaro, to find the Big Dipper if they're not familiar with what to look for? They would never find it. No, they wouldn't. You say that because you have Google. You say that because you could go Google it. I'm talking about an uneducated individual who's looking at the nighttime sky for the first time. They wouldn't see it. There's too many data points. See, the Big Dipper stands out to you because somebody along the way taught you how to see it. Somebody taught you the pattern. Somebody taught you that there's 7 stars. Somebody taught you how to see the 3 that connect to the handle. You've been taught it. It's inherently designed in that. But if you don't know what to look for, you don't know the qualifications, you don't know the data points, it's impossible. And yet, a 5-year-old child can spot the Big Dipper within 3 seconds in the nighttime sky with a billion different data points. Think about that. 1 billion data points, and we can find the nighttime sky, the Big Dipper, within seconds. Trading should be a little bit easier than that because we're not looking at that many data, but it's all a pattern. Everything that we deal with is a pattern. Patterns have a tendency to manifest themselves over time. They determine probability, and they're all done through simple pattern recognition from a standpoint of there are basically basic types of patterns. You have trending patterns, you have you have trending patterns, you have continuation patterns, and you have reversal patterns. Those patterns we have to master. So when you're looking at the S&P 500 on a daily chart, what is this pattern? What would you call this overall pattern that we're looking at in the S&P 500 right this very second? It's an ascending triangle. That's exactly what it is. It's an ascending triangle. Now, how do we know that? Well, Jay, how do you know that? Gabber, how do you know that? Because you've been trained. You've been taught the same way somebody looking at a constellation in the nighttime sky has been trained. It's been taught. That's all it is. It's a visual pattern. And in determining that pattern, did you consciously go through the triple top with the increasing support level, or did it just stand out on the screen? It's like, oh yeah, I didn't even think, and that's an ascending triangle. And if you don't even think and you know that's an ascending triangle, you also know the trigger mechanism is a close above the triangle resistance level, which would be the continuation trigger to see the next trend begin. You see it stands out to you. When you look at the NASDAQ, okay, what would we call this pattern on the NASDAQ? It's a symmetrical triangle. Right? It's a symmetrical triangle. You can often consider it a wedge as well, depending on the time frame, but it's a symmetrical triangle. And symmetrical triangles can be traded in two different varieties. And I'm just talking on the bull side. You can be aggressive when it breaks the triangle, or two, you can wait for the triangle to get broke into the upper level of resistance and then trade that breakout. That's how you navigate symmetrical triangles. There's two different trigger mechanisms, same thing on the downside. Every pattern has a probability edge to it. Every pattern has a way that you technically navigate it. No, it's not a flag of it could be a flag on, say, a longer time frame, for example. But even on the longer time frame, I would actually call it a high base. On the weekly time frame, I would call it a symmetrical triangle. I would not consider this a flag. I would consider this first move here on the weekly chart a flag, William. And so when you're looking at a symmetrical triangle, you have basically increasing support versus decreasing resistance in a symmetrical triangle. So do you see how we have decreasing resistance and increasing support, and you're starting to get it become really pinchy over here? That's a symmetrical triangle. But my point isn't this to learn how to navigate symmetrical triangles today. It's to master the visual recognition of the pattern, and then you master how to navigate the tradable side of that equation. And so when you're dealing with patterns in the market, there's a lot of different patterns in the market. Once again, you have every pattern has a bullish and a bearish variation. That's number one. Number two, you have three categorizations of patterns: trending patterns, continuation patterns, and reversal patterns. Now, as we detail these patterns over the next couple months, we're going to take one pattern and we're going to detail that till everybody has a specific understanding of both the visual recognition of the pattern and how to trade the pattern. And team, would you say that's time well spent? If over the next couple months we can recognize all patterns in the market and simultaneously learn how to navigate those, Omaro, that's the thing about patterns. Patterns happen on every time frame, my friend. Every single time frame. And so a symmetrical triangle can be on a 30-minute time frame. A symmetrical triangle can be on a daily time frame. And Coach Breezy's 1000% correct. Every pattern is a fractal pattern within the larger construct of the pattern that you're looking at. And so before we get into the multiple time frame analysis of that, realize there are patterns within patterns, and patterns can happen on every single time frame. So yeah, a symmetrical triangle. If you see that on a daily chart, that's a daily chart symmetrical triangle. That is not a symmetrical triangle on the 1 hour chart. That's not a symmetrical triangle on the 5 minute chart. There's going to be different patterns that you look for. But in terms of the patterns that we focus on, we're going to focus on pattern recognition. It's not going to be, I'm going to do stuff on the weekly time frame. I'm going to do stuff on the daily time frame. And absolutely, I'm going to do stuff on the intraday time frame because you saw a beautiful, thank you, RQ, for this find, but you saw a beautiful reversal happen on the intraday time frame. And nobody looking at this daily time frame is going to say, what bullish reversal? It's been going up, 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 up forever. Well, you look at the 15-minute time frame. Yep. Left shoulder, head, right shoulder, neckline, break the neckline. Now you're a bullish uptrend. So you have a head and shoulders formation happening on the 15-minute chart. It's impossible to have a head and shoulders on the daily chart. It's impossible to have a head and shoulders on the weekly chart because that's just not part of the analysis. And so it's not necessarily, don't get me wrong, we'll talk time frame too, but this study, remember, we're building the BluSky Technical Playbook. This is about patterns in general, mastering patterns in general, not just on a single time frame. Because as a trader, if all you ever do is trade one single time frame, I have a tendency to believe you're not going to be a trader very, very long. Okay. How many of you agree with that, by the way? If all you do is laser focus on one single time frame, that you're not going to be a trader very long because that time frame doesn't always work out. There's time frames within time frames. We got to be able to understand how that works. We'll get into that here in just a little bit. So we're going to do some basic pattern recognition. Okay. Just some really, really basic pattern recognition. And patterns are historically based. So what everybody's going to do is they're going to tell me what the next most likely pattern is. So you have a pattern on your screen right here. Triangle, circle, triangle, circle, triangle. What would the next most logical probable pattern be? Circle, right? I'm not trying to trick anybody. Okay. We're not trying to trick anybody. We're not trying to fake anybody out here. Patterns are historically based. They have a tendency to repeat until they don't. Here's another one. Star, star, arrow, star, star. What would the next most likely pattern be? An arrow. That's pattern recognition. It doesn't have to be more complicated than that. We identify the historical pattern to determine the next most likely probable pattern. And when you're dealing with a trend, there are three repeating patterns in a trend. You have breakouts that start the trend. You have overextension, which is pattern number 2 within a trend. And then you have the eventual retracement, which is called the bullish retracement in an uptrend or the bearish retracement in a downtrend. Those 3 patterns manifest themselves out all the time in trending analysis. That's how you navigate trending analysis. But that's not the only patterns out there. We have other patterns. And so just to give you an understanding of the totality of patterns out there, and this is not a complete list, ladies and gentlemen. These are just some of the core patterns out there. On the continuation side of the equation, you got a couple different ones. You have your ascending and your descending triangles. Ascending triangle, descending triangle. Do you see how you have horizontal resistance? You have vertical support. Horizontal resistance, vertical support is an ascending continuation pattern. Because you have constant increases in support, the buyers or the bulls still control the pattern. The ultimate trigger mechanism is when you break the pattern, and that is going to be commonality in every one of these patterns that we look at over time. So you got ascending triangles and you got the bearish equivalent of the descending triangle. So every bullish pattern out there has an equal and opposite bearish pattern out there. You simply flip the chart upside down, same concept. Now you have that descending triangle. You also have bull flags, bear flags. You have pennants, i.e., wedges. You have symmetrical triangles, both on the bull and the bear side. And so, from symmetrical triangles to wedges to ascending versus descending to cup and handle patterns to bullish megaphone patterns, you have a lot of different types of continuation patterns. And because you have a lot of different types of continuation patterns, there's a variety of different ways of how to navigate those. But at the end of the day, regardless of what the continuation pattern is, whether it's an ascending triangle or a cup and handle, whether it's a descending or a wedge, it's not inside the pattern that you're really trading. The pattern determines the probability of the next movement. We're trading the next movement, which means we're identifying the pattern to know the next movement, which means we're looking at the breakout. And Amara, you're absolutely right, 100%. This is not a complete list of all the different patterns out there. This is just, and there's fractal patterns within these patterns. This is just a core list of the patterns that you master as a technician. You also have reversal patterns out there. Reversal patterns can be extremely powerful, like we saw play out on silver today. They play out on the intraday side of the equation quite a bit. And there's not an infinite amount of reversal patterns. There's only three, guys. Three patterns. On the reversal side of the equation, you have to master three patterns. What are they? You have channels. I don't really consider reversals, quite frankly. Channels I consider K-trade analysis. I'll talk about that as we get a little bit deeper into it. The three I'm specifically talking about are head and shoulders formations, like we saw. Look at this screenshot here. Okay. And then you come over here and you look at silver on their reversal today. Kind of looks like the exact same thing. Kind of looks like the exact same thing. Left shoulder, head with slowing momentum. That's a very key point in a head and shoulders reversal where you have this violation of support. You see this quick run down. You see this violation of support. You see this little move to the downside. That's a slowing momentum. The head in a head and shoulders formation, you definitely want to see that slowing momentum. And then you have what's called a deeper retracement that blasts through any bearish retracement analysis because the slowing momentum, it doesn't have to take much. You get back up above those moving averages and you come work into this overhead resistance that gets dialed in, breaks out, that confirms that head and shoulders move. You see that over here? Very similar. And so you master the look, then you have an understanding of the specifics that you look at. You also have double bottoms, double tops. That's known as the W formation. You have double tops, double bottoms. That's known as the M formation. N stands for murder. You have the 1, 2, 3, which is known as the V-shape reversal, where you don't have the left shoulder of a head and shoulders. You basically just have the right shoulder of the head and shoulders. And then when you break out, that's the V shape. I prefer a head and shoulders because of the time correction, but you got to be familiar with the V shape as well. You also have the kisses, the kiss hello in a bullish reversal. You have the kiss goodbye in a bearish reversal. There's a lot of different patterns out there. My job and our job over the next couple months as we're developing the BluSky Playbook from a technical pattern perspective is not just to identify the baby one, the baby Nora one. Yeah, I got to figure out that's a momentum one. It's definitely a momentum one there, Ace. K trade, Baby Nora picks. We go with Baby Nora. But really, when you master pattern recognition, that's one thing. Learning how to qualify that pattern is another thing. And that's where you really want to start getting into the specific qualifications of a specific pattern in the market. It's one thing to know what a breakout is. It's one thing to know the patterns going into a breakout. It's another thing to know specifically how to trade it and how to qualify it because not every breakout is identical. Not every retracement is identical. Not every pullback is worthy of your trade. Not every breakout is worthy of your trade. You have to learn how to qualify those breakouts to see which ones are excuse me, which ones are great patterns versus which ones you don't want to take. And that's when you start getting into primary qualifications and secondary qualifications. What would I mean by a primary qualification? Excuse me, got the hiccups over here. What would I mean by a primary qualification? Somebody give me a hint, give me a guess, give me a technique that would go in a breakout. What would the primary qualification be? Volume. I put volume into liquidity, and it would definitely be a primary qualification. Inside pattern development on before you go into a breakout, you want to see a slight consolidation of volume as you're breaking out. You want to see volume expand. Volume is a primary qualification. We need to understand specifically what to see on the volume side of the equation. That's a great one. Resistance, support breaks, first confirmation. Ultimately, here, Coach Breezy, you're talking about the pattern that goes into it and confirmation specifically. Confirmation is absolutely a primary qualification because confirmation, according to Jesse Livermore, who is one of the greatest traders of all time, if not the greatest, said confirmation is the key, is the insurance that you write on your projection. If your projection is up, you're not right until it confirms that. Confirmation, massively important. What about secondary qualifications? What might we consider a secondary qualification? And primary qualifications, you absolutely have to have. You cannot get around it. You have to have your primary qualifications. Secondary qualifications, you don't. But what would I be referencing here? Okay. Support levels, moving averages, supporting. I could see that, yeah. Think like this. Do I absolutely have to have RSI in a specific level to justify this trade? RSI being a secondary indicator. No, but if I do, I like it a lot more. Does that make sense, guys? So secondary qualifications are things that you want to see. They're things that it would give you much greater confidence in going into that trade as a secondary form of analysis. Does that make sense though, just in terms of the primary qualifications versus the secondary qualifications when you're qualifying a specific pattern? And if you have great primary qualifications and the secondary qualifications certainly give you that, the next step is to prep the trade. Okay, you don't have to go through anything more detailed. Prep the trade. And yes, Amaro, based on what Coach Becky was talking about on Tuesday, I visualize a lot of this. Yes, a lot of times I'm not going through the nitty gritty of everything. I am visualizing a lot of this, no doubt. Coach Breezy, breaks pattern, retest. I would call that a snapback. Take 100%, 100%, a secondary analysis, no doubt about that. Okay, so let's look at just the breakout. Now, this is to give you an understanding of how to qualify it. I am going to do breakouts again. I just wanted to spend a little bit of time showing you guys how I qualify the primary qualifications to a specific pattern versus the secondary qualifications to a pattern. So the primary qualifications to a breakout is number one, you have to have a breakout pattern. Lots of different breakout patterns, but you have to have a breakout pattern. And there's a lot of them: high bases, cup and handles, ascending triangles, breakout within a trend. Like you break out of resistance. Typically, you can say that's some degree of breakout pattern, but you got to have a breakout pattern. Number two, liquidity. Liquidity, and I'm going to go into a little bit more detail than just this, but liquidity goes to both volume, kind of volume qualifications that are happening on the pattern itself, but just general liquidity. Now, as day traders, let's face it, we live in liquidity. It's usually not a problem when you're looking at the ES, the NQ, GC, SI, any of those major, day trading tradable instruments. All of those are extremely liquid. But it's not just liquidity, it's also volume. There are specific requirements for volume in each pattern. For example, in a pullback, you want to see less volume than you had in the upward movement in price. In a breakout, you want to see additional volume as you're breaking out. And so volume does go into that liquidity. Price confirmation, I saw Coach Breezy say this, price confirmation, absolutely key. You have to see confirmation to ensure that you're right on your projection. Can you put orders to get involved upon confirmation? Yes, that's aggressive, but you can do it, but you definitely got to get those orders above that confirmation level. And fourth, these are it. That doesn't have to be more complicated than this. You have to have a positive reward to risk ratio, meaning at target number one, you definitely need a 1-to-1 reward to risk ratio. At target number two, which is your real target, you need to make sure that's a positive reward to risk ratio that is north of 2-to-1. Those are your primary qualifications. So when you look at qualification number one, breakout pattern, we know there's a lot of patterns that can go into a potential breakout. So we see the market up, gets overextended, pulls back, and then going into the breakout. This is a flag-based pattern going into a potential breakout. You don't have to have a prolonged consolidation pattern, a prolonged consolidation ascending triangle or cup and handle. A high base works, a flag works, a trend works, whatever it is. You just have to have a breakout pattern, meaning you don't want to be overextended going into a breakout level. You want to see a pattern develop at that level. Okay, whether all roads lead to that or some other form of analysis, I can promise it doesn't. All roads doesn't lead to that, but that is certainly one of those very popular techniques. But you got to identify that resistance level. You got to identify that pattern going into the resistance level, and then when I'm looking at that breakout, one of the things that's important to me going into the breakout is and I'll talk about this in a second as well, but a concept called room to run. How many of you have ever heard of that concept, room to run or open air? That concept is to understand when you're going into a breakout, do you have room for it to run? Do you have a legitimate opportunity where it can run without getting smacked in the face by some other form of analysis? And so room to run is very important to make sure that you have the distance in a breakout to justify the reward to risk ratio. If you don't have room to run, you don't have a good trade, quite frankly, because you want in breakouts are momentum based. You want to see the momentum take over. You don't want to break out to go up one day, come right back down. Not if you're trading the breakout. That'd be a different pattern if you're not trading the breakout. But if you're trading the breakout, you want to see this thing break that 120 level, have room to run. And how you determine room to run is you look at it not just from a visual perspective, but you also think about it from the distance perspective. For example, if this stock has an ATR of $2 and from this level of the breakout to this target here at the 128 level, this old support level on that high base at the 128 level, if that's only one ATR, you don't have that much room to run. If that's four ATRs, you got a ton of distance there. And so the ATR, the average true range, is a very, very important indicator to help us understand that room to run. For example, once again, if the ATR is eight and you got an $8 range, that's not a swing trade, guys. That's a day trade. If you have a one ATR range on a breakout, that's more of a day trade situation than it is a swing trade because you want to have three, four standard days up for the room for the price to kind of breathe, for it to find that open air before it gets into another form of resistance. And so when you're qualifying that breakout, it's not just about the level, it's about the level, it's about the pattern that's going into that level, and it's about seeing ultimately how far something can go. So one way I'm looking at that room to run is I'm looking at it through the lens of the visual identification. How far can this bad boy run before it gets into any major levels of resistance? For example, I come and I look at a stock like DigitalOcean, DOCN, and I look at it on the daily chart here. And on the daily chart, I'm looking at this breakout. Did we just break out 2 days ago on DigitalOcean? Yes or no? By the way, it's a cup and handle breakout. That's a cup and handle continuation breakout on DigitalOcean. Now, on the daily chart, can you identify the room to run here on the daily chart? Yes or no? I don't think so. Which means you're going to have to look at a little bit more time frame here tomorrow. So I'm going to come out to the weekly. I'm going to come out to the weekly chart to kind of get an understanding of what we're really dealing with here. All right. So what we're really dealing with here is we're dealing with a massive, massive, massive breakout. And you really don't run into any overhead until you get to 60. And above 60, you really don't work into any form of resistance until you start getting into 88. So when you look at this visual on the weekly chart, do you have room to run? 60 would be target one, and then it opens up. So when we look at the weekly chart, do we have room to run? Yes or no? Yeah. So am I dealing with an open air environment where price can work to 60, and then when it works above 60, then we really open up in room to run. So I'm looking at through that lens, number one, the room to run. This in room to run. The second way I'm looking at it is through inside the pattern, what were the historical ranges? Before from support to resistance inside that pattern to help me understand kind of the personality of the pattern recognition inside the pattern. So coming back out to DigitalOcean here, you have this move here. That's about a 12-point move. You then have this move here, which is an 11-point move. You have this movement here, which is a $7 move. And so I'm trying to understand how far something can run upon the breakout, and that would lead me to that $60 as well. And so I'm trying to understand when I'm looking at the historical analysis, not just is this a high quality breakout with room to run. I'm trying to look at also the historical ranges to help me understand exactly where this thing is going to move into the future. So that's another way you can look at it, is through historical ranges. I like to look at it more through the visual recognition when I look at that daily chart, coming out to the weekly chart, looking at the ATR distance. That's my preferred method, but I have no problem if somebody wants to use historical ranges with inside that pattern as well. One of the secondary qualifications in helping us understand that concept of room to run, which is extremely important in breakouts, is RSI. RSI stands for relative strength index. It helps us measures the magnitude of the upward movement in price to the downward movement in price in comparison to one's own volatility. And what you want to see in RSI, guys, to justify the trade, to justify that concept of room to run, that concept of open air, is if RSI is underneath 50 but above 70. If RSI is if RSI is above 50, underneath 70, that's what we call a positive slope with room to run. And so you're not overextended going into the breakout, which tells me that once it does break out, you again have room to run. Whether it's looking at it through the multiple time frame lens, whether it's looking at it through historical ranges, whether it's looking at it through indicators such as RSI, we're trying to qualify that breakout. We have a good level, we have a good pattern, but ultimately do we have the return? Because that's what we're trying to accomplish here is where is those ultimate targets? Do we have that ultimate positive reward to risk ratio that we need to justify the trade? Now, primary qualification number two on breakouts is liquidity. Now, when you're dealing with liquidity, there's a couple different things you want. When you're trading stock, guys, or when you're trading futures, they're all liquid enough to do what you need to do. But when you're trading options on the liquidity side of the equation, you definitely want to see two things. Number one, you see this open interest. We want to see hundreds, if not thousands, on the strike prices on open interest that we're trading. The reason is it goes to the tightness of the bid-ask spread. The more liquidity, the tighter that bid-ask spread is, the tighter that bid-ask spread, the better it is to get involved on the option side. So if you're trading options, you're definitely going to want to check the liquidity on the strike prices you're trading and on open interest. As long as you got 100 on open interest, you're typically fine. I'd certainly want more, but if you have 100, you're typically fine. And volume can be low. Volume can be low, but you definitely need to see some volume. You can't go to this strike price right here and say, oh, I got one open interest and I got no on volume. I'm going to be the market. You don't want to be the market maker in the options market. You definitely want to have liquidity. And the reason's very simple. Anybody can get in to an option trade. Not everybody can get out of an option trade, especially if you're dealing with spreads. So you're going to want to make sure that's liquidity. However, what we're looking at in the breakout from a volume perspective is while you're inside pattern, okay, while you're inside pattern, especially as we get tight to the breakout. So just the last few days here, okay, just kind of those days right there. What you want to see as you're going into that breakout is you want to start seeing the volume expand going into the breakout. There's thousands of indicators, guys. Not everybody uses all of them. I wouldn't recommend to use all of them. I personally do use RSI. I definitely use RSI for breakouts. I would recommend it. But if you don't use RSI, I'm not here to tell you to use RSI. There's thousands of indicators, and there's a lot of indicators that help understand overextension. But RSI is one of the best, most traditional ways to do that. Now, in terms of the volume, let's stay focused here though. In terms of the volume, I don't care who it is, you want to see an increase in volume going into the breakout. You want to see participation here. You want to see domination. You want to see that upward movement in price that is coupled with the volume. That is Wyckoff theory. That's one of Wyckoff's number one rules is you got to see volume to support the price when you're talking about a breakout. So we got volume expanding as we're going into the breakout. That's a very good sign. And that's a very good sign regardless of the time frame you're looking at. If you're swing trading on the daily chart, if you're day trading on the intraday chart, if you're position trading on the weekly chart, going into that breakout, you want to see that uptick in volume to show higher participation, meaning it's not just you with your precious system. It's broadly supported. It's supported by retail, it's supported by the funds, it's supported by Wall Street. You want to see broad participation when you're going into that breakout. That's the liquidity requirement. Now, when you're measuring liquidity, the most important part of it is just to make sure whatever you're trading has liquidity. But specifically, as you're going into the volume profiles, you want to see that increase in volume going into that breakout. Now, primary qualification number 3. This is also a very important one. And I believe Coach Breezy said this one just a little bit ago. Confirmation. What is it? How do you look for it? And do you need to see it? The answer to all of those things is vitally important, and absolutely you need to see it. Confirmation is the insurance you write on your projection. Confirmation on a breakout is when the candle closes above the breakout channel. On any time frame you're looking at, when the candle closes above that breakout or that breakout channel, that is ultimately confirmation. Now, traders will front run confirmation. That goes more to entry technique, identifying your resistance level and then getting an order above resistance to trigger in upon the breakout. That's an aggressive way to get involved in a breakout. But if you're looking at more of the conservative variety, you wait on the close, get the order in above the candle high, and you ride that momentum as long as that momentum takes you. That's ultimately confirmation. And so, how do we identify it in the real time? Well, you identify your level. You already know you got the pattern going into it. And right when it closes above resistance, that is the sign that you now have confirmation. Maybe you don't love the candle. Maybe you don't love the volume. Maybe you don't love something about it. Maybe there's going to be something else that stops the trade idea. But once that closes above your level, you now have textbook confirmation, and the order once again would go above the high of that confirmation candle, and then you ride that next trend as well. Primary qualification number 4 is positive reward to risk ratio. Whenever you're processing any trade on the short term, day trade, swing trade alike, you need to have 2-to-1 at your ultimate target. Reward to risk ratio at T1, because every trade that I ever make, I have 2 targets in mind. I have T1, I have T2. It doesn't matter to me if it's a day trade or if it's a swing trade. I have 2 targets in mind. T1 is a decision target for me. T2 is a get out target for me. Other traders are going to be a little bit different than that, but every trader needs to have 2 targets in mind. T1 is your short porch target, where you're going to start trailing stop loss, where you're going to scale out of the position. T2, that would be a get out target. At T1, you need to have a 1-to-1 reward to risk ratio or better. At T2, you need to have a 2-to-1 reward to risk ratio or better. Those are your primary qualifications. So when I go into a situation like DigitalOcean here, and let's come back out and let's go to DigitalOcean here. So when I come into a situation like DigitalOcean, I'm looking at the pattern, cup and handle pattern, that tells me what I need to see. I need to see confirmation. Oh, there's my screenshot there, Ace. I need to see confirmation that I'm right on my projection. Do I have a cup and handle pattern? Do I have a confirmation candle? Do I have room to run? And do I have increasing volume going into the breakout? Have I answered affirmatively on all 4 of the primary qualifications here? Yes or no? Yes. So what's the next step? Prep the trade. Vodka's right. Prep the trade. That's the next step. I don't know if you do 50 micros on Docu, but or on DigitalOcean, but yeah, you get the point. You prep the trade. Well, and that goes to how you personally qualify this breakout. Like if you don't want to chase this candle, I'm not discussing that, Ace, because that's personal choice here. You could say, give me 3 bars inside and let me get that breakout out of the intraday. I agree with you. That's how you personally navigate that. What I'm suggesting is it answers the question on the qualifications. Now, secondary qualifications are a little bit different. Secondary qualifications go to the longer term trend. It goes to, and I use RSI, guys. I'm not saying you have to use RSI. Whatever secondary indicators, everybody provide me one secondary indicator. Vodka, we're traders. We never full port. That's not us. I totally get that you were joking. I hope everybody else understood you were joking too, because we don't full port. We're traders, and you're traders for the next 20 years, not for the next 20 minutes. So totally got the joke there, brother. But back to RSI. I use RSI to help me confirm it, but that's just one of many indicators out there, guys. There's a lot of indicators that can help you confirm breakouts. What indicator do you use to give you a secondary confirmation tool on a breakout? Trendline break, MACD, love MACD. Yeah, I'm a big fan of MACD. Well, Murado's delta goes to the strike price that we're trading, and it's just a directional position. DMI, ADX crossovers, nice. Well, and again, it could be anything. I'm not talking, I was just giving a case study of a recent one that I took on DigitalOcean, but it could be anything. Could be a 15-minute breakout on the ES, could be patterns are patterns. They happen on every single time frame, VWAP, everything. Because as we build this playbook, guys, this playbook isn't the Matt Justice playbook. It's not the Coach Matt playbook. It's the BluSky playbook. I want to make sure that these secondary qualifications that we talk about are not just how I historically done it. I want to make sure that we're building the BluSky playbook here. Does that make sense, guys? I think you could make an argument over stochastics over RSI. Yeah, I think you could definitely make an argument. I think both of them are fairly good, fairly traditional. Okay. But do you also see that when you're talking about a breakout, it's not just as simple as saying breakout? Like there are primary qualifications, there are secondary qualifications, and we need to make sure that we go through those qualifications to ensure that we are getting high quality patterns. Because that's what I feel is powerful from a tradable side of it, side of the equation, is constantly trading high probability patterns. Did you guys have fun today? As always, did you increase that IQ today? The financial one. Okay. Now, like I said, we are going to do this once a week, every week. And in the lab, basically what my thought process is, and I'm going to spend about half of the time in the lab detailing a technical pattern each week. Okay. That's number one. But I'm also going to make sure to take some time at the end of the lab to have Q&A. And so in the first 30 minutes of every lab, we are breaking down qualifications on technical patterns. The next 20 minutes, we'll be doing application analysis, taking what we're learning, applying it to the market, talking about that market that day, talking about the market that week. And the last 10 minutes of the lab will be designed for your time. You have a question on a trade, you have a question on anything we're covering, that's your time. So that's the lab. That's what we're going to do over the next couple months or until we get done with this. And I'm looking forward to every single conversation. I know I had a ton of fun here today. Thank you so much for hanging out with me today. We will do the same thing next time. By the way, Becky, correct me if I'm wrong, but we're going to go record the first Blue Sky podcast. Like we're going to go do that recording right now, correct? Justin, am I hearing from you too? Nice. So, Becky, myself, Justin, and Coach Riz, we're going to be doing a podcast, weekly podcast. We're going to be doing a lot of fun things, a lot of different segments, but it'll come out on Monday. We'll do the recordings every Thursday. It will be released on Monday. And yes, we're very exciting. We're definitely going to be bringing on guests. Absolutely. In fact, anybody here that wants to be a guest on our pod, Justin's doing the interviews. Message Justin because we are looking for more and more guests. And we want to make this really about Blue Sky and about the Blue Sky community and about you guys. And obviously helping everybody navigate every single week, making sure everybody's familiar with what's going on this week, but just fun conversations by traders in Blue Sky and bringing on guests to Blue Sky, and it's going to be a lot of fun. That will be dropping next Monday, and we'll definitely. Vodka, if you don't think I'm not going to drop a couple one-liners, you don't know me that well. Now I'm going to try to confuse a little bit, but I'm going to drop some one-liners every now and then. Oh yeah, oh yeah, oh yeah. Ace, I would love you as a guest on the pod. Love, 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 love. All right, team. Have a wonderful, wonderful rest of your day. Thank you so much for hanging out with me today. We'll do it again next week, same time, same channel. Thanks, everybody.